15, 5, 1 minute. Those are your first 3 time frames to worry about. You don't need any other time frame. This is what you're doing. You're studying price at specific times of the day. If you're not writing this part down, you're blowing it already. So what is it reaching for? It's reaching for old highs, old lows, and inefficiencies. That's the fair value gap. So once we know that the market is likely to do these things, that's a characteristic. It's an algorithmic characteristic. You don't need anything else besides this element as a foundation to what you're trying to trade, and you can make all the money you'd ever want. I go in and I'm looking for reasons why the market will trade to this level, why it could potentially trade to this level, but I don't need it to trade, for instance. This is the draw on liquidity. Draw on liquidity is just an initial reasonable assumption on our part to determine a directional move that could unfold. It does not mean and it does not define the absolute terminus to a price run or the be-all end-all target. In plainer terms, the market's probably going to keep moving until it gets to this level. It doesn't mean that it can't have retracements lower. It doesn't mean that it can't make a lower low than it's done here. Highly unlikely. So when we're looking at price, does it have what it takes to move to these highs here? A way of saying it to yourself that's very disarming is, okay, I see how this is smooth. These 2 highs are relatively equal. That looks like a real nice, obvious flat space in price. We don't see that same flatness down here. Anytime that you're looking at price action, and it doesn't matter what time frame you're looking at, this principle is always true. The market will go to an area of smoothness for the purpose of disrupting any orders that would be resting above or below it. So what does it look like to be smooth? Well, when you have price levels that create highs, like this swing high here and this swing high here, they're real close to one another. See that? When you're looking for relative equal highs, here's your secret weapon for it, okay? How do you know it's a high probability relative equal high that's likely to get swept or traded through? What differentiates that from any other, okay? It's this. If you have 2 swing highs, if the one to the left is slightly higher than the right, you have a very, very high probability that they're going to want to take it above there, just like you see here. Here's what's going on. This is called priming, okay? Priming is where you continuously create, inspire, or manipulate the expectations of a large number of investors. And they think, oh, it's going to go through that high. But then there's a lot of folks that don't want to see it go there because they went short. So when the market goes up here and stops and turns down, what that does is it creates a sympathetic sigh. The shorts are relaxing. If the shorts are relaxing, what are they saying? They're saying that this is now what? Resistance. So anyone that takes a new short position, where are they going to think that the safest place to put their stop loss is going to be? Right above these highs. Why can we trust that they're likely to take that relative equal high out? Not that it will that session that you're trading, but it's high probability that this will be swept when the second or the one to the right, that swing high is lower than the one to the left that frames these 2 as relatively equal. Okay? Same thing is occurring here. We have this high here, this high here, this one being slightly lower than that one. Anyone that went short here, they feel like, okay, that's scary because it almost went that high where their stop loss would be if they're trying to go short in this area. See that? So what do you think it looks like when we have relative equal lows? What would be a high probability relative equal low that the market is likely to draw down and go below? It would be a low that has a slightly higher low. In common terms, it's referred as a failure swing. So a failure swing, you're trying to trade that. That's what a failure swing is. When you're trying to trade long or short on that second pass that doesn't take out the low or take out a previous high. That's selling short a failure swing. Okay. What I'm teaching you is how to identify in price action where the algorithm will refer back to and why. What are the central tenets as to what the algorithm is referring to at a specific time of day, most important. And then it refers back to these because, okay, it sees this high based on time, and then the high prior to that one is here. So it's very simple for the algorithm to call that information as an array, and they're in close proximity. Now let me go back to the times element. Every day between 8 o'clock in the morning, this is always New York local time, okay? Between 8 o'clock and 8:30 in the morning, you want to sit down and determine where are the smooth locations in price action on the 15-minute, the 5-minute, and the 1-minute. So right away you can see that this high here is relative to that one, and this one here also with that, this one being slightly higher than that one. So there's a lot of liquidity that's sitting at 17,820.75. Now, real important, it does not mean that it has to happen during that session. It does not mean that. And that is the underlying risk that you assume every single time you take a trade. You're looking for things that are going to stack the odds of probability in your favor. Now also notice that we've created again high, lower high, high, lower high, but real close to one another. When did it form? Prior to 9:30. So we have 8 to 8:30, and then you study 9 to 9:30, because it's going to do what? It's going to look and seek the liquidity or inefficiencies. So here's 9:30 there, forming on the bullish breaker. It trades down, and then we have relative equal highs here, this high and that high, relative equal high, and we have this area up here. So if the market's going to do what? If it's going to make a punishing move towards the shorts that want to see it drop, because the market has dropped early on, 7 o'clock in the morning, and we have all these very clean levels. What did we just do here? We have a low. It was traded down into, it disrupted this little area in here. So it's made this area jagged. The market's real smooth over here versus what it was doing down here. Why did I pick this high? What's the first thing I told you? The algorithm is going to go based on time. It matters not that we're trading Forex or futures. The morning session, AM session, starts at 7 o'clock in the morning, New York local time. So your key times are this, 7 o'clock in the morning to 7:30. In that 30-minute window, you're going to look for relative equal highs and relative equal lows that have happened prior to 7 o'clock, okay? And you're going to be looking through the time frames of the 1-minute chart, the 5-minute chart, and the 15-minute time. Since the 15-minute time frame is pretty static, you only need to refer to it once in the morning. And then your second chart could be the 5-minute chart. Then what you're doing is you're watching between 7 o'clock and 7:30, or 8 o'clock to 8:30, or 9 to 9:30 opening bell. You're looking for where is the market smooth, because still waters invite rocks, okay? So what's the market going to do? Every single session in the morning, you have three opportunities in the morning. If you can contrast one side of the marketplace against another, when you set up a framework of whatever you're going to study in the morning, if you're going to trade the morning session, your key times, you have to absolutely be in front of the charts between 7 o'clock and 7:30 in the morning, always New York local time. If you can be in front of the charts by 7 o'clock, this is what you're doing. But if you can't, you do the same thing at 8 o'clock to 8:30, the same thing at 9 to 9:30, okay? This is your pre-market range. Write that down, because if you don't write it down, you're going to forget. You're going to call it the opening range. It's not the opening range. The opening range is the first 30 minutes after the opening bell. At the New York session, the first 30 minutes after 7 o'clock to 7:30, that is your pre-market range. 7:30 to 8 o'clock is your opening range. And obviously the 9 to 9:30, that's your pre-market range. And then post 9:30 to 10 o'clock, that's your opening range. It's a 30-minute opening range. That's algorithmic. So what you're doing, and this little range here that's being shown here with this rectangle, what I'm saying is this is essentially that 30-minute interval, whether it be 7 o'clock to 7:30, or 8 o'clock to 8:30, or 9 to 9:30, that pre-market range. In that range, what you're doing is you're looking at this line, or beginning of that shaded area, would delineate the 7 o'clock, or the 8 o'clock, or the 9 o'clock, where it begins at that specific top of the hour. And then this would be the range that makes up that first 30 minutes. Prior to that range, anything before or to the left of this, you're looking for equal highs or equal lows. Which side has it? Because that's your bias. It's going to draw to that. How do you know? If you have both, you wait for the first one to get disrupted, because once that happens, then you work to the other one. That's your bias. So you have to defer and wait. Whichever one has the relative equal highs or relative equal lows, that's a smooth area. It will be disrupted. Anywhere where you see jagged edges like this down here, see how it went jagged and then ripped higher. What is it telling you? I'm going to look for buy side liquidity, buy stops. This has been a trap. They engage traders to go short. They're trapped short on a breakout, or they're not trying to take the shorts out of the market yet, and that's why you see all this in here, a little creeping up. This is all balanced. That's why this spike stopped right at the top of the breaker here. You don't trade into levels where the sharks have already had a frenzy, and that's down here. Okay, they've already done the work. There's been an attack down here. How do you know? There's been the great disturbance in what price was doing and how it's delivered. It's jagged like shark teeth cutting through the side of a whale's body. It's been damaged delivered. You can see it. It's physically represented in the jaggedness of the swings going down, where we don't see that jaggedness up here. It's nice and smooth, real inviting. So when you're looking for the bias, okay, the easiest, most scientifically proven, 9 out of 10 doctors approve, ICT has nailed it down to a science of wherever the smooth equal highs are or smooth relative equal lows are, at the beginning of 7 o'clock to 7:30, or 8 o'clock to 8:30, or 9 to 9:30, you have 3 opportunities, 3 chances, okay? As each one of these time windows passes by, so at 7 o'clock, we formed the relative equal highs. And then at 8 to 8:30, we didn't go up there yet. So that means that, 9 to 9:30, chances are that's the run. See how that does that? It increases the likelihood of it going there. It doesn't diminish it because it's building up more trust in that area right there.